and it certainly raises questions of how deep in the vault, have they gone?
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. My name is Shane Moran, and I'll be your host for this episode. And from the entire Live from the Vault team worldwide, we want to thank you for your continued support. And as you can imagine, this community keeps growing more and more every single week, and there's a lot to talk about during these historic times. And Andrew Maguire is in the house with an industry expert, and by popular demand, Lyn Alden of Lyn Alden Investment Strategies is in the house. We'll be welcoming her in a second. And we'll be talking gold today. This is going to be an amazing episode. You won't want to miss a word here, because Live from the Vault gives you access to information and updates that you just can't get anywhere else. And this episode is no exception. And just before we go to talking gold with Andrew Maguire and our special guest, Lyn Alden, please help us spread the word about this channel by hitting that like button, sharing this with everyone you know, and also subscribe. If you hit the bell right there, you'll be notified as each episode goes live. So with that, let me introduce our special guest. Lyn Alden is the founder of Lyn Alden Investment Strategies, and she started it in 2016, providing institutional level research in plain English so that both institutional investors and retail investors can benefit from it. So Lyn's work has been editorially featured in the Wall Street Journal, Business Insider, Market Watch, Times Money Magazine, the Daily Telegraph, the Philadelphia Inquirer, The Street, CNBC, US News, World Report, just to name a very, very few. Lyn has also served as an advisor for startup companies, hedge funds, executive committees, and of large institutions. So with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our special guest, Lyn Alden. Over to you, Andy.
Well, the first thing I must do is say this is very special, and thank you so much for joining us, Lyn. It's been really looking forward to this, and I think really our focus. I think one of the things that really makes this special is our focus. We have this sort of almost myopic view of the gold and silver markets. We live and breathe it. Obviously, we're on the. Personally, I'm on the wholesale side. Also, I've been an active whistleblower. It was a great deal of my evidence was actually what brought down the NOAC and those guys at JP Morgan. I've been working with the CFTC, DOJ since 2008. And really, a lot of that evidence took 10 years to really crystallize. So we just want a level playing field. That's all we ever cared about. That's what markets should be. I brought my children into this marketplace, and I want it to be fair. And I think, I think, if I could just open by saying, look, obviously our focus is on the gold and silver markets. And from a long-term perspective, there's probably very little doubt that over 5,000 years, gold has proved itself as the ultimate wealth protection asset class. Forget about making money, that is a wealth protection asset class. But to assess the medium and short-term action, obviously as traders, as a stacker, it doesn't matter, but we have to weigh up the input, the crosses that affect our investment timings. And I could just think of no better source to assess these really important crosses that impact our decision making. And Lyn, I read your specialist October newsletter. Huge interest in that, and it really addressed my concerns, relating to the sovereign gold bubble. You were so early in drawing attention to that in 2019. I didn't see that. I didn't see that before now, but I look back at what you've done. That you were talking about 18 trillion in negative yields back then, at a time when the mainstream media was spinning the mantra inflation was dead, and you proved them dead wrong. Interestingly, this once again addresses the question that you posed back then. Also, are bonds safe? And really, this is where I'm just going to ask you, can you share your thoughts on Let's just start there, Lyn, and share your thoughts on this, please.
Yeah, so back several years ago, before the pandemic and before some of the craziness that happened, I was analyzing markets, and there was a lot of concerns about, say, stock valuations, how expensive they were. And I was saying, okay, this is, that's a legitimate concern. There are a number of highly valued equities out there. There's also some cheap ones. But I said the more remarkable thing is what's going on in the bond market, where, you had, mostly in Europe, you had a lot of negative yielding debt. And then you had basically zero yields in Japan. In the United States, we had, near zero on the short end of the curve, a little higher, when you go out. And so basically, it's super low yielding debt. Most of it was below the inflation rate. And the idea was that inflation's dead, it's never coming back. Was one thing I looked at from researching history is that normally when countries get very indebted at the sovereign level, so very large levels of debt relative to GDP, they kind of go past the event horizon where that debt is ever going to be paid back in purchasing power terms, right? And so obviously different countries, depending on their debt profile, will handle that differently. If you're an emerging market and your debt is denominated in a currency you can't print, like dollars, or if you go back long enough and some countries would have like gold reparations and things like that, they can't print those things, and so they could outright default on some of their obligations or restructure them, which is another way of saying default. Whereas if the debts are denominated in their own currency, normally it's through inflation, right? So it's financial oppression holding yields below the inflation rate, and the kind of the post-war era. In Europe it was the 20s, and in the United States and much of the world again it was the 40s, where a lot of that sovereign debt was eviscerated in real terms, and I started to see kind of a similar dynamic building here. And none of the risk was priced in my view. I think it's some of that's been priced better now, but I still think that this has been a historic bond crash globally. Tens of trillions of dollars have been in paper wealth and wiped out of the sovereign bond market, let alone the corporate bonds that are all the other types of bonds that are kind of associated with those yields at a higher level. And going forward, say treasuries are less terrible looking than they were, but generally speaking, I think most sovereign paper wealth is not going to do very well in purchasing power terms, say, over the next decade.
That's really interesting. And of course, because I think 70, I don't know, you probably know better than me, but 70 or 80% of global trade is conducted in dollars. And then, so if you're a foreign central bank, then you have to likely hedge that in your own currency, which must create huge problems.
Yeah, there's a growing issue where, ironically, the United States like dollar market, as big as it is, it's not really big enough to serve the whole world anymore. When this system was constructed with the dollar and the treasury at the core of the system after the post-war era, the United States was over like 40% of global GDP. It was kind of like the last country standing. And it had all the gold, it had all the military, and it had all the economy, the industrial capacity. And as things have been rebuilt, and then as multiple countries have risen in power, we live in a more multipolar world now, right? So the United States is closer to 20% of GDP, depending on how you look at purchasing power parity, it'll be less than that. If you look at nominal dollar terms, it's a little bit above 20%, but it's certainly reduced its share of global economy, but it still has a very large share of that global payment and reserve volume. And I think it's kind of squeezing parts of the world out. And now, obviously, for geopolitical reasons too, but I think even before some of the events of this year, there was a recognition among multiple countries that they want to diversify their payment and reserve situation. That's different than saying, we don't want to hold any treasuries, but it's saying we want to diversify the types of assets that we hold. And then for some of the largest countries and some of the largest currency blocks, they had an interest in being able to, say, purchase oil in their own currency, and then have those oil producers maybe hold, those sovereign bonds. And so it's you're actually it's a circular economy there where, say, China can buy oil from, Russia, and then Russia can take that currency, they can hold it. They can also go back to the Chinese market and buy, electronics and things that China produces because they're a large manufacturer. And I think that's the world we're still kind of headed towards. It's a more multipolar world. And then I think, this year certainly added some fuel to the fire because now every country realizes that there's counterparty risk with where they hold their reserve assets. And so I think that there's multiple things that have been not good for the bond market. And if you're say an oil producer, or even if you're an oil consuming country and you're holding reserves, and those reserves are losing value relative to oil, for example, kind of hard assets, it's a melting ice cube. And so no oil producer wants to sell all of its kind of finite resources and then put them into melting ice cube assets. At the same time, if you're a country that is holding those reserves because of the idea that in the future they can hold their value and you can buy, say, oil or other imports with them. If that is a diminishing value, it cheapens like the purpose of reserves. And so I think we're kind of undergoing a transition here.
Yeah, and so and it's funny, in the lead up to Russia invading Ukraine, we saw really them ditch pretty much all their treasuries and move into physical gold, and really openly move into physical gold. And I think that sort of kind of raises the thought in my mind. And when we look back, and you're a historian, and you know. And when I think about it, that while the BRICS countries and the Saudis and Russians, etc., accumulate physical, China, of course, it raises the question, and this is again something that's interesting, because the gold collateralization of US foreign obligations is now at historic lows. It's like something like 3 or 4%, and when it used to be 20 to 40% historical average. So, and I think Basel III, I think after March 2020, we saw a huge implosion of the exchange for physical market blow up. We saw the liquidity providers in the spot market being turned upon for delivery when they had nothing to back it up. And I think Basel III was brought in, and SFR conditions were brought in. I think the bigger, while that addressed the put a band-aid essentially on the issue, I think the bigger picture here to me is what's the Bank of International Settlements doing here? Because suddenly I'm trying to connect all these dots. They've brought in these NSFR standards, which means essentially if you're a liquidity provider holding a gold position, you better have that physical available if you're called on it. And I think now we see the Bank of International Settlements calling in leases, reducing their swaps to historical lows. I mean, we're talking 50 tons now. It used to be 500-600 tons. And I kind of wonder, is anything going on here? Is this a story about US dollar hegemony? Is it at risk? I mean, what do you think?
Well, so there are people that study those nuances of the gold market at a much deeper level than I do. But a general trend that we're seeing, obviously, is that gold's moving from west to east, essentially, right? So a lot of the physical gold is going to China, going to India, going to Turkey, going to Russia, as you pointed out, multiple countries throughout kind of Eurasia, the BRICS nations, and so there's that general migration of the physical metal, where some cultures they either have the trade surpluses to absorb it, or their society values it more, views it as more of a store of value, whereas a lot of Western investors have somewhat lost interest in it, and a lot of the Western countries are running these deficits anyway. So there's this general flow, which kind of corresponds to the rise of power of Asia as an economic force in general, and so we are seeing kind of those interesting dynamics in the gold market. And it's obviously been a long story where multiple people can think they have exposure to gold and not really have exposure to gold. Like if things really hit the fan, if you kind of put the cards on the table, who has the gold? A lot of people think they have gold, but if they actually were to all kind of call on those claims at once, some of them would be obviously left without it. And I think that the market is kind of going through that process to sort some of that out. And obviously that can have long-term implications about price, right? Because if you can increase the supply of claims without increasing the supply of the underlying, that can obviously be negative for pricing. Whereas if you have a kind of a truer perception of where the gold is and who owns it, that can be constructive for price as long as the demand is there. And so I think that's a trend we're seeing. And it's interesting because gold, obviously gold's had a rough year this year, but if you compare it to like long duration bonds, which is one of the closest things you'd compare it to, gold held up better than most long duration bonds did. So it was, it didn't go up like a number of people would have hoped, but it did some damage control in a portfolio or in a net worth.
Yeah, and I think again we're back to the wealth preservation aspect. And I think if you're a 10-minute chart trader, yeah, it's volatile. Of course it is. I mean, you've got a paper market, you've got a physical market, you've got a viscous coupling, you've got the EFP coupling, and yeah, and silver isn't an SFR compliant, so it tends to be a little more volatile. But I think it's really interesting because we see here a dynamic, a shift. For example. Since the COMEX was instigated somewhere 50 years ago, pretty much 50 years ago, and it was really to address. It was after Nixon came off the gold standard, and essentially what it was really 2 years later, the COMEX was formed, and it was the ability to create limitless amounts of paper gold at will, and of course. Being in a margin, being margin, borrowed, etc., and the hedge funds running with that flow, as you say, never really necessarily owning anything of the underlying. I think what's changed is since Basel III and SFR standards came into play, I think we have seen a shift, and it's interesting because we speak to our liquidity providers at the end of each day, and these guys are really, really strong. In making the markets global markets, and they're saying, you know what, if anything that does transfer through, other than what can be flywheeled in unallocated form into the GLD or the ETFs, which aren't necessarily allocated, it can be a flow of unallocated in and out, and it doesn't necessarily get allocated, but essentially. It is getting it's a change. It's a change of behavior. And whereas the COMEX was never, ever intended to be a delivery market, now, I will raise silver for the moment here. As of last week, there's such a divergence between the silver physical market, where we have almost COVID-like conditions in the European refiners, Swiss refiners, Valcami, all of these guys that we speak to are on an energy cap. And essentially, why are you going to use your energy bandwidth in refining silver when you're already capped as to how much you can use, and you can do it more profitably with gold? So suddenly, and I think the point I'm trying to make here, suddenly, as of last week, my European wholesaler said, "The hell with it. We're going to collect this gold from the COMEX." Now, it's not usual to have a loadout from a COMEX warehouse. It is usually just it's a warrant shuffling exercise, and everyone settles out. No one's ever going to take delivery, probably, so you can get away with that. But for 10 to 12 cents, we can fly this stuff out into Europe, which is starved for physical, and we can suddenly, literally, drain the COMEX inventories. Now, it's interesting. Any thoughts on this, or changes, these dynamic changes?
Well, so I think you obviously outlined it very well there. That you have, these specific conditions. That's something I've been tracking in a broader scale. Not necessarily focusing on those refiners, but for example, because of the energy shortages in Europe, there's a number of energy intensive industries that have either voluntarily shut down or been basically given like a kind of an order to shut down. And so you've seen that in fertilizer companies, you've seen that in multiple types of metals producers, as well as obviously consumers trying to ration their energy where possible. And so that obviously can have an impact. And it's often during these idiosyncratic type of events that broader things get revealed, right? So I mean, the idea of a market where people trade claims on something and then never take physical delivery is kind of it's kind of a game, right? But then if there's events every once, a few times in history where people actually say, wait a second, we actually want this, it's kind of a test on that system to see, how's that going to go, and it kind of keeps the industry more honest, to that, when delivery has to happen. And then there's also, I mean, I think that a number of sovereign buyers over time, I think I've realized that custody matters, right? So a number of countries hold their gold outside of their jurisdiction, and a number of them have kind of over time decided to repatriate that gold, and to the extent that they continue buying gold, they generally some of them want to bring it in their borders, as well as private entities in those countries. I think as we move towards a more multipolar world, kind of, east and west, maybe trusting each other less, or, multiple different parts of the world trusting each other less, that question of custody matters more. And so I think that the gold can become less kind of centralized and more spread out to those jurisdictions. And I think that's a general trend.
Yeah, and I think it's so right on because I mean we've seen sanctions being imposed on Russia. We've seen sanctions being imposed on China. And there's this sort of lurking fear that hang on, maybe I should have I should repatriate my gold, especially gold. I mean, gold is money, so essentially you need to have that repatriated. And then we saw that interesting story. I don't know if you remember in 2013 when Germany asked for their 300 tons, tiny 300 tons back, and it was going to take 7 years. And really we suddenly thought, well, hold on a minute. It raises issues of rehypothecation. I mean, what? I mean, we're not a conspiracy theory. It's like, why? I mean, I can move 20 tons of gold on a plane, and I could have done that in a week. So why would it take 7 years? And it's suddenly, and then we find out as this gold arrives that some of it's old bars, they need to be remelted, reprocessed. And I'm just wondering, do you think that this 8,000 odd tons of US dollar held gold, is it possible that there is rife rehypothecation, that it's been leased, sold multiple times over?
I think it's certainly possible. And like I said before, there are people that study those types of questions at a deeper level than I do. But it is one of the challenges that you have to essentially trust what they're saying. And there has obviously been a history of countries kind of dipping into things like that, when they feel like they need to. And so I wouldn't have full faith that those all those tons are there as stated. I even brought up the question before to my audience. I was like, if the BRICS nations, right, they've been talking about doing like a commodity backed currency or partially commodity backed. They're kind of floating ideas out there, and I kind of asked the question, like, would you trust their supply audits? And would they trust each other? And then people ask the natural question. I mean, would you trust the United States, especially if there's no audit, right? And so, I think some of these, kind of sovereign level questions, I think are worth asking because I would say it's not fully clear that all the gold is there as expected. And I think that, as you've seen that migration from west to east, I've heard, for example, about those old bars, and it certainly raises questions of how deep in the vault, have they gone?
Yeah, that's interesting too. And I think now in your when you talk to your clients, and obviously whether it's private or whether it's not, generally speaking, do you suggest to your clients that they should have some exposure to gold and silver within their asset classes?
Yeah, I generally recommend a non-zero position, right? And obviously the sizing can vary based on someone's, what type of capital they're running, what their conviction is in the asset. But I generally think that, zero is not the right number for most people, and that having, some position is worthwhile. And then of course how they want to hold that can differ. I mean, one of the advantages of gold and silver is that you can custody some. It's nice to have a bearer asset. And of course there's also ways that you can link it to like payment mechanisms and things like that. So for people that want that price exposure and are willing to have someone else custody it. And so I think that, especially given what's happening in sovereign bond markets, and then the longer term question about, what are countries going to, use as sovereign reserves if we go through this kind of long term period of financial repression where bond yields are below the prevailing inflation rate, and there's some counterparty risk out there. I think we're kind of entering an environment where gold is likely to be more attractive than sovereign debt in a lot of cases. That doesn't mean every single year. For example, we've had such a sell-off in bonds that I wouldn't be surprised, that now at these higher yield levels they're a little bit more interesting. But I think longer term there's going to be this financial repression where paper assets generally struggle in purchasing power terms compared to real assets, and gold would be one of the types of real assets along with silver.
And I guess really it so much depends on your client's time perspective, time frames. Obviously, I mean, perfect example. I was with somebody, a client, who said, "Oh, Andrew, I just sold my business for £700,000. What do I do with my money?" And I said, "Where is it?" He said, "It's in the bank." I said, "Oh, okay. You do realise that's an investment decision you've made there. That's not just a warm, fuzzy feeling between your ears. That is an investment decision." And then you've got inflation running, this country, 10.1, 10.3%. So really, I mean, think about that as an investment. But then he said, "Yeah, but Andy, isn't it? It's just so volatile." I said, "Hold on a minute." So we drew up a chart, and there, in the dollar index just hit 20-year highs. But what was the price of gold in dollars? $315 back then. So it throws that volatility aspect right out the window, because as a wealth preservation tool, so I suppose really time is the key answer here as to what percentage you want to put into gold.
Yeah, and I think it also depends on the opportunity set of what else is out there, right? So if you're in an environment where multiple assets are very cheap relative to your assessment of how well they're going to do. So in other words, you have a high rate of return expectation on multiple types of assets. In that type of environment, then maybe people want a lower gold allocation. They want to go out into those, more generating type of assets, capital, to have a higher rate of return. Whereas if you're in an environment where multiple things are very highly priced. Like going back to sovereign bonds in 2019, I mean, negative yielding bonds or near zero yielding bonds. That's basically another way of. And if you have a sovereign bond yield with a 1% yield, it's kind of like saying 100 price to earnings ratio that is not going to grow but is super safe, right? And so does that sound attractive to people? Most people would say no. But then you say, well, what about a 1% yielding treasury? And back then people were like, yeah, that seems fine. Or obviously zero or negative in many cases. And so in that environment where the opportunity set of stocks and bonds in general is unattractive in terms of forward returns, then gold becomes more attractive. And historically, if you look at things like the CAPE ratio, the cyclically adjusted price to earnings ratio of the S&P 500, as an example, during periods where it's highly valued, generally the next 10 years, stocks underperform gold. Whereas the inverse is true. If the CAPE ratio gets very, very cheap and you're able to actually get good dividend yields and good earnings yields and basically the equities are underowned, then generally going for the next 10 years, they're likely to outperform gold. And so I think we're in that environment where it's not at some of the extremes like it was before, but I think the opportunity set out there is really challenging, especially for the S&P 500, these big tech stocks that I think are still somewhat pricey, as well as still looking at much of the global sovereign bond market, and I think that the opportunity set of gold is better than a lot of those over, say, a 5-10 year period going forward.
Yeah, and I think another aspect, again, very gold centric, but when we see the liquidity flowing out of the paper markets of the COMEX into the physical exchanges globally, it's becoming much more of a physical asset. So I think on the other hand of things, we're thinking as another dynamic is what is the real price of gold? And if you take away that big, enormous 50 years of accrued paper, this paper sort of wall of supply that's been coming in. And suddenly we look at the COMEX, we look at it closely, we look at and obviously it's one thing to look at the COMEX because yes, you look at the COT report, you can see who's long, who's short. But what is missing from that report is, of course, what's happening in the over-the-counter markets, what's in the 10 times larger over-the-counter markets. So it's really not a great deal of help. But essentially what we are seeing is we look at the open interest evaporating. We see as wholesalers where this is going. And I think this is, again, back to Basel III, forcing, I think, certainly in gold. I mean, silver's joined at the hip, so I'm sure at some point that will have an effect too. But there's that other dynamic of gold actually becoming a more of a physically priced supply-demand aspect. And look, we were paying last week, and okay, it's come off a bit now because while India was very strong, we were paying $15 an ounce over in Dubai for wholesale kilo bars. Now, hang on a minute, that is That is a huge disconnect from what is actually the tail wagging the dog, the COMEX tail wagging the physical dog. Because then you're getting a fixed price, but the fixed price is actually determined by just 3 to 5 tons. When the global demand is global physical demand and deliveries is multiple times that. So it's kind of siloed in this little ring-fenced world still, which is, I think, I can see this changing rapidly as liquidity flows out. It's going somewhere. So I think the fact that gold should have a revaluation element to it. People ask me what the price of gold is. I don't know what the price of gold would be. I couldn't even guess, to be honest. But it certainly seems like a good element, especially you talk about the bond market being broken, essentially, is it not? Then these are other things to bear in mind, in my view.
Yeah, I think, during periods of history where we have kind of these just shifts into how the global financial system works, right? So, you had a shift, in say the 40s, you had another shift in the 70s. I think we're in that kind of era now. When you look at charts of major shifts, there's a lot of kind of similarities here. And so I think that investors do have to be aware of the possibility of nonlinear events, right? Where things change, over the course of a year, over the course of a weekend in some cases, and just things are different after that. And then you could have a pretty significant repricing in some assets. And I think gold is kind of near the top of the list of things that could go through repricing. And kind of by its nature, predicting something like that is impossible or very hard. It's kind of any given year, it's a low probability event. But I think that we're in that type of decade where some of those low probability events are going to happen. And I think we've already seen some of them. And I think that a shift in how the gold market works and how it's priced and kind of a check to see who actually has the gold is kind of one of those possibilities. And one of the catalysts that I think could contribute to that is right now, the market does kind of expect that inflation's transitory. If you look at, for example, inflation break-evens, for example, like the bond market's forward assessment of what inflation's likely to be, they're looking at much lower numbers than it is now. And I do think that we are in a disinflationary period from the prior kind of that big spike in inflation. So I think in a number of places that the inflation's coming off, but I think that we're still in a structurally inflationary environment when you look at, for example, the energy capex situation. And I do think that once the Fed gets done with their period of tightening, I think that eventually the market's going to have a reassessment of forward inflation expectations. And that could change a lot of investor behavior around, how they treat bonds and how they look at gold, right? Because right now, with the dollar soaring and with yields going up and investors kind of expecting that inflation is transitory, they're looking at these things as though they have positive real yields. And so that obviously, when you can get positive real yield on a bond, that can be pretty attractive relative to gold. But if the market reassesses its forward inflation expectations with rates at these levels, and you kind of have reassessment and you start looking at it and say, what if we're in a long period of negative real yields? Then gold becomes, it gets increased attractiveness. And so I think there are some catalysts to look for going forward. And it's, when I was looking at the bond market, a few years ago, it's just like it's like the market was just not looking into the future at all, or at the same time, it's not even looking into the past. It's not looking in terms of history of what happens when bond markets behave like this. And I think we're kind of still in that environment now, where there's not a full recognition, I think, of how trapped a lot of these highly indebted sovereigns are in terms of their ability to maintain the purchasing power of those bonds. And I think that as that becomes more fully kind of assessed and priced in by the market, and as we kind of grind through this year over year, and people kind of realize that some of these issues are going to be with us for a while, I think that could make gold more attractive. And then while you're going through those processes to kind of reduce the kind of the games in the market, I think it can kind of result in a repricing.
I think you've distilled that absolutely brilliantly, and I think people should replay that, because honestly, I think you've just that is really illuminating. And I think Excuse me, I've got a helicopter coming by. Hopefully, they haven't come to pick me. JP Morgan come to pick me up out of my desk. But I was going to ask you the other thing. I was going to ask you. There's two things that I'm probably going to ask you still, which is now November the 8th, midterms. Again, I'm this side of the pond. I don't know. I mean, but do you think that if for example, the Democrats lose control of the Congress, is that going to change anything, any dynamics at all?
Well, so right now, both polling and betting markets are suggesting that Republicans are going to win one or both houses of Congress, and so we would enter a more split government. In some ways, it's already been split. I mean, the Senate in particular has been, especially the way that it works, where when we have a filibuster, for example. There's limitations on what you can get through anyway. So we've already had a somewhat split government. It's going to, I think, get more split going forward. And so I think a lot of people assume that that kind of locks in, that it means no new spending. And I think that could be true, but it also means no new taxes probably, or very, very challenging to raise taxes, right? So when you look out long term in the United States, we've got structural $1 trillion deficits as far as the eye can see. And then with the increased interest rates over time, as that some of that debt comes due and gets reissued, basically as that debt rolls over, it starts going up in terms of interest payments by the federal government, and that actually increases the deficit even more. And so as we kind of look out, and that assumes no recessions, right? That assumes no recession in 2023 or 2024, even though, for example, the yield curve is currently inverted. We have kind of a slowing, a decelerating economy. And so even assuming no recession, it is very, very large deficits. And that's generally this type of more inflationary type of environment where you have a deficit that you can't fully control. You can't really raise taxes politically. You can't really cut some of these programs that are very politically popular. It'd be very unpopular to cut them. I think a lot of that kind of forward spending is already locked in, and so I think that in some ways gridlock just reinforces that further.
And finally, the Fed, Powell, the Fed tomorrow, FOMC tomorrow. I mean, I guess we figure 75 basis points baked in. Do you think there's any kind of, I mean, there's been talk of a pivot, of slowing down. What do you think? What's your thoughts? You're so well connected. I mean, you probably have got a good sense of what they may be forced or not forced to do.
Well, so they were kind of hinting that they might start initiating language about still hiking, but at a slower pace. And I think that's probably on the table now. We did get a decent job report, a job opening report, and also we've had some Fed officials kind of walk back some of those dovish things and kind of reiterate a hawkish view. So maybe they go another meeting before they introduce that type of language. I think there's kind of a toss up there, but I think that with rates where they are and kind of the state of the economy, I do think that we're probably getting to a period where they're going to that the rate of change, the hawkishness and rate of change terms is probably peaking, even though in absolute terms they're obviously not at the rate that they want to get to and that the market's pricing for. So I think that that's going to be something to keep an eye on. And I think a longer term dynamic is really just to focus on the energy market because the U.S. is drawing down its strategic petroleum reserve. I think somewhat past the midterms that's probably going to stop. Or they could keep pushing it further, but there's obviously there's only so far they can draw that down. At the same time, China is still under kind of these rolling lockdowns, which reduces flights, it reduces just various types of fuel use, and as Europe kind of continues to go through a natural gas shortage, and right now, for example, there's unseasonably warm weather. They got the storage tanks full, but over time, but there's also demand destruction. A lot, like as we talked about, a lot of plants are closed, right? So as you want to kind of move forward and reopen, there's still a lot of energy demand, and there can be substitutions, right? So you can have more coal, you can have more oil usage, for example, and I think that the market is too kind of calm about what could happen with oil over, say, a 5-year period, right? If you look at a lot of analyst expectations when they, Wall Street analysts, when they look at, say, an oil company and they kind of price out what's going to happen, they usually assume like 60 or $70 oil. They kind of assume that this spike's just going to go back down, and we're going to kind of go to this like, kind of low plateau. Obviously, different shops have different price estimates, but for example, if you look at Morningstar analysts, they're using $60 oil for their long-term assumption, and that I don't think that's a world we're going back to. I mean, you could maybe hit those types of numbers briefly if you have a sharp enough recession and period of demand destruction. But when you look at the supply side, I think that's still going to be an inflationary variable. During COVID, there was a big shift in terms of kind of overnight people's demand shifted, and that put a lot of stress on certain aspects of the supply chain, and that's coming off, right? That extreme level of shift is kind of behind us. But I think that the second story here is the ongoing, energy markets. And I think that essentially what happened with natural gas in Europe kind of happened with oil over like a multi-year period. And I think that that's a risk to be aware of. And that has all sorts of implications for bond pricing, that has implications for equities, that has implications for um, you know, uh, gold, for example. And I think that's something to watch. And I think that one of the catalysts is that, when the Strategic Petroleum Reserve stops going straight down, that's supply coming out of the market that's going to stop coming out of the market.
And today I heard whether it was trial balloon or what, but we saw, we're talking about, the US was talking about energy caps on Russia. Is that feasible? Is that possible?
Well, I mean, there's ways that they can try to cap it, but then the problem is, can they get it, right? So, kind of the history of price caps is that price caps lead to shortages, especially when you're trying to cap something outside of your jurisdiction. There's also been, if you're an energy producer and, you're kind of a scapegoat now for various politicians that are dealing with inflation, and they say, well, it's the energy company's fault, right? I mean, if you look at most, long-term charts, energy companies have been terrible investments for like a 15-year period. They've generally not done very well, and it's not like no, when they were not making money and they were going through bankruptcies, no politician wanted to save them. But now that they're actually having a profit, there's suddenly like these people are floating windfall taxes, they're floating nationalization. Obviously, different jurisdictions are handling that differently. And if you're an oil company, you're looking at this environment, you say, okay, well, we don't know what oil pricing is going to look like over the next several years. And we also don't know what percentage of our profits we're even going to get to keep. I mean, essentially, we have all the downside if oil has a bearish scenario, and we could have our upside capped in some way. And so that certainly is not an attractive environment to put billions of dollars into long-term projects. I mean, you can do short-term shale type of work, but if you're going to go offshore, you're going to do some sort of like large investment project. It's not a very attractive environment for that to happen. And I think that so many people look at the demand side of energy, and I think that supply side is going to continue to be pretty tight going forward. And you know that's only one of the variables. There's also just it takes a long kind of investment cycle to bring more oil online, and I just think that we're still like nowhere near kind of starting that in earnest.
And the very last, you've been so generous with your time. The very, very, very last question: silver. Any thoughts on silver?
Well, I mean, it's a more volatile metal than gold. I think they generally, more often than not, they go in the same general direction. And so if you were to have, a bullish move in gold, I think that silver would likely follow, and probably with greater amplitude. Um, I think you have to be more careful with position sizing when it comes to silver. Just because of the volatility. It's also got that long-term usage in a variety of technologies. And so it's that hybrid metal between, it's got a monetary premium, but then it's more used in industry. And so I'm constructive on gold, silver, and platinum really. I think, and same thing for copper, for example. When you look out long term, I've been cautious about copper in this kind of decelerating economic environment, but when I look out long term, I'm quite bullish on copper. So I think that the kind of the broad commodity spectrum, whether it's gold, silver, platinum, copper, oil, on different time frames, I think are all pretty attractive. I think we're at the early innings of a commodity decade. That'd be my base case. Now I continue to reassess that as new data comes in, but my kind of base case for a while, for a number of years now, and still going forward, is that I think this is like a broadly constructive decade for commodities.
That's fantastic. And that's a great place to end, Lyn. Thank you so much for your time and your thoughts today. Really sage information. I honestly think that people will probably need to listen to this more than once. So thank you so much for joining us. And please, I'd really love to have you back again. And we could maybe have explore a little more about perhaps, as you say, things are about to roll out. Your thoughts here. We're watching all those things: the energy markets, bond markets, and really would love to have you back at some point when we've sort of perhaps got through to the new year.
Yeah, I appreciate you having me. Thank you.
Thank you so much.
Thank you, Andrew Maguire and Lyn Alden, for another fascinating discussion. And remember, buy physical and make sure it's 1-to-1. And understand the difference between what Andy affectionately calls the casino paper and gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another episode of Live from the Vault. We're going to add some links down there if you want more information on Lyn, and help spreading the word about this channel by hitting that like, share this information, hit the subscribe button, and also click on the bell if you'd like to be notified as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.